Have you ever wondered why so many young high-income professionals work hard, finally save up 1 million Kenyan shillings, and still end up losing money? It's not because they invested wrong, it's because they started in the wrong place. Today I'm going to show you what 99% of young professionals skip before investing 1 million Kenyan shillings and what the wealthy always get right. Kenya's current money landscape. Kenya's financial world has changed. Interest rates are high while inflation erodes 6 to 8% of your money every year. However, digital investment platforms have made access easier, and with 1 million Kenyan shillings, you suddenly unlock investments most professionals never access, like infrastructure bonds, high-growth land parcels, and premium business opportunities. But 1 million Kenyan shillings is a great investment only if you have the right strategy. Otherwise, it becomes one stressful decision after another. The million-shilling mindset. Let's fix the first problem, mindset. Because once you hit this level, your emotions start making decisions for you. Here are the 3 traps that derail most investors. Number 1, loss aversion. The fear of losing money becomes greater than the desire to grow it. Number 2, FOMO. You chase hot tips, hype, or whatever's trending on TikTok. Number 3, overconfidence. You assume you'll double your money in a few months. Wealthy investors do the opposite, they slow down, plan, and then execute. Here is the pre-investment checklist. The part everyone skips. Number 1, emergency fund. Before touching that 1 million shillings, make sure you've set aside 3 to 6 months of expenses. This protects your investments from panic withdrawals. However, the typical 3 to 6 months of savings may fall short, especially for young high-income earners with steeper living costs. Aim for 9 to 12 months of expenses for greater security. Number 2. High-interest debt. If you're paying 15 to 20% on loans, clearing that debt is a guaranteed return. It's risk-free and often beats investments. Number 3. Risk appetite test. Ask yourself, if my 1 million Kenyan shillings dropped to 850,000 Kenyan shillings for 3 months, would I panic sell, hold or buy more? Your answer tells you if you're an aggressive, balanced, or a conservative investor. Number 4. Investment horizon. Before you invest 1 million Kenyan shillings, you must understand your investment horizon. It's simply how long you can leave your money invested before you need to use it. Let's break it down. Short term, 0 to 3 years. If you need this money within the next 3 years, maybe for school tuition, a car upgrade, or an emergency buffer, you cannot afford volatility. So prioritize liquidity and stability. Think money market funds, treasury bills, and high-yield savings. These protect your money while still giving modest returns. Medium term, 3 to 7 years. Now the 3 to 7 year window is your sweet spot for balance. You want some growth, but also some safety. This is where a mixed strategy works best, part in low-risk assets, part in growth assets like bonds, SACCOs, REITs, and even selective equities. The goal here is to achieve steady growth without having sleepless nights. Long-term, 7 to more than 15 years. Long-term money is your wealth-building money. Here time is your biggest advantage, it smooths out the ups and downs. This is where high-growth assets like stocks, index funds, private equity or venture capital exposure, real estate development, and business investments come in. This is how young professionals build generational wealth, by letting compound interest do the heavy lifting. So before you invest, ask yourself, when will I need this money? Because once your horizon is clear, choosing the right investment becomes simple. Number 5. Financial goals. Are you investing for a home, passive income, retirement, or wealth growth? Your goal determines your strategy. Number 6. Investor personality. First, we have the DIY investor. This is the person who loves being hands-on, researching options, comparing returns, and making their own moves. If you enjoy picking your own investments, this might be you. Next is the delegator. This investor prefers to hand things over to professionals, fund managers, financial coaches, or automated portfolios. If you want growth without the day-to-day decisions, this style fits perfectly. And finally, the hybrid investor. This is a mix of both worlds. You manage some investments yourself, but you also delegate certain parts to experts. Perfect if you want control and guidance at the same time. Knowing who you are helps you choose platforms, products, and the right level of guidance. Why diversification is critical. 1 million Kenyan shillings is a good amount to start with because it's enough to diversify. That's your biggest protection against market shocks. Diversification does three things. 1. Reduces risk. When you spread your money across different investments, you're not depending on one asset to work perfectly. If one asset goes down, another can balance it out. That's how diversification reduces your overall risk. 2. Smooths your growth. Diversification also makes your financial journey less stressful. Instead of big swings up and down, you get steadier, more predictable growth over time. It's like averaging out the bumps on the road. 3. Protects you from bad advice. And finally, diversification protects you from that one person who always tells you, just put all your money here. No single investment deserves 100% of your hard-earned cash. A diversified strategy keeps you safe, disciplined, and focused on the long game. Now that you have the right mindset and the right foundation, we are going to build your actual 1 million Kenyan shillings portfolio, including stocks, global ETFs, MMFs, real estate, and the side hustle bucket. The 5-bucket wealth plan. Let's talk about the fun part, where to actually put your 1 million Kenyan shillings for maximum returns. And I'm going to break it down into a simple 5-bucket wealth plan anyone can follow. Here are the buckets. Income growth bucket, wealth growth bucket, stability bucket, liquidity bucket, and long-term assets bucket. This plan ensures your money is working in every part of your life. Some grow fast, some grow safely, some stay accessible, and some build long-term wealth. Let's explore each bucket. Bucket 1, Income growth. This is any business or side hustle that increases your income. Why should you include this? Because no investment outperforms increased earning power. Ideas include Airbnb units, digital services, franchises, agribusiness, and online coaching or products. Here is a good rule of thumb: if it doesn't have clear demand, clear margins, or clear cash flow, don't touch it. This bucket generates active income, accelerating your wealth journey. Bucket 2, Wealth growth. This is your main engine for building long-term wealth. Examples include Kenyan blue-chip stocks and global ETFs. When it comes to blue-chip stocks, look for companies with strong cash flow, market dominance, and dividend consistency. ETFs are essential for reducing Kenyan market risk and gaining stability. Before investing, consider dollar-cost averaging. Even with 300,000 Kenyan shillings, don't put it all at once. Spread investments across 3 to 6 months to smooth out market volatility. This bucket is for growth, but you must be patient. Bucket 3, Stability. This is your safety net. Examples include treasury bonds and T-bills. Bonds offer higher yields, are long-term, and stable. Keep in mind that infrastructure bonds are tax-free. Use a bond ladder strategy to maximize your investment. Buy bonds with different maturities for consistent cash flow. T-bills are great for short-term targets, stability, and protecting your money during market dips. Bonds and bills protect your portfolio from uncertainty. Bucket 4, Liquidity. This bucket ensures you can access money fast without breaking long-term investments. Examples include money market funds. Before putting your money into MMFs, look for portfolio composition, custodian bank, fund manager track record, net returns, and stability score. MMFs act like a parking spot for opportunities and emergencies. Bucket 5, Long-term assets. This bucket is for wealth preservation and long-term growth. Here are some examples. Asset 1. Land banking. Look for areas with infrastructure development, title clarity, and population growth. Asset 2. Rental property. Use the 1% rule and cap rate to estimate profitability. Asset 3. REITs, real estate investment trusts. Before investing in REITs, consider these two types. Income REITs, they pay regular dividends. Development REITs, they finance new real estate projects. This bucket grows slowly but powerfully. Asset 4. Alternative investments. These are high-risk, high-reward investments. Only invest here after your main buckets are funded. Examples include crypto, forex, P2P lending, and private equity. Think of this as your experimentation zone. Now that you know exactly where to put your 1 million Kenyan shillings, I'll show you how to maximize your returns using tax strategies, and how to avoid the mistakes that cause most investors to lose money. Risk plan, tax strategy, and the perfect portfolio. If you lost half your money today, would your investment plan survive? I'll show you the exact risk and tax strategies that protect and grow your 1 million Kenyan shillings. Let me ask you a question: do you want high returns, but you can't sleep when you see your portfolio drop? Keep in mind that your emotional capacity matters as much as your financial capacity. Here are the 3 levels of risk appetite you should be aware of. Number 1, conservative investor. This type of investor prioritizes stability and capital preservation and prefers MMFs, T-bills, and conservative bonds. Their volatility tolerance is low. Their typical investment outcome is slow but with steady compounding. Number 2, balanced investor. This type of investor mixes growth and stability and is comfortable with some volatility. Conservative investors include stocks, bonds, MMFs, and REITs in their portfolio. Their typical investment outcome is higher returns than conservative investors. Number 3, aggressive investor. This type of investor is comfortable with fluctuations and holds more stocks, ETFs, and alternatives. Even though their investment outcome has the highest potential, it has the highest swings. Note that risk appetite isn't about age, it's about behavior under pressure. For example, investors in their 20s can be conservative, while investors in their 40s can be aggressive. Now let's talk about tax strategies that boost your returns. Most young high-income professionals focus on returns but ignore taxes. And in Kenya, taxes can quietly reduce your returns by 10 to 25%, depending on the investment. Here are tax strategies for investors with 1 million Kenyan shillings. Number 1, maximize tax-advantaged accounts. Private pensions allow up to 30,000 Kenyan shillings per month tax-deductible contributions if the scheme is registered. Your pension grows tax-deferred, and withdrawals at retirement are taxed at a lower rate depending on how much you withdraw. Number 2, use tax-efficient investment vehicles such as REITs, infrastructure and green bonds, and long-term treasury bonds. REITs distributions are tax-exempt, infrastructure and green bonds are tax-free, and withholding tax for long-term treasury bonds is lower compared to short-term bills. Tax-free infrastructure bonds can outperform many high-return investments once you calculate after-tax returns. Number 3, explore tax efficiency in real estate. You can offset rental income using repairs, property management fees, mortgage interest, and wear and tear allowances. For example, if you own rental properties, you can reduce your rental tax from 14,000 Kenyan shillings to 3,600 Kenyan shillings per month, legally, just by documenting expenses correctly. Number 4, structure your business for tax efficiency. Register as a limited company to lower your effective tax rate and deduct expenses for things like laptops, fuel, internet, and insurance. Over time, this helps you keep more of your profits. The ideal diversified portfolio for 1 million Kenyan shillings. If you have 1 million Kenyan shillings and are not sure how to grow it safely and smartly, let me show you the perfect balanced portfolio for long-term growth. First up, stocks and ETFs, 30% of your portfolio, that's 300,000 Kenyan shillings. These are for long-term growth. ETFs help spread your risk, giving you instant diversification. Think of this as your wealth engine. Ideal if you can leave it untouched for 5+ years. Next, treasury bonds and bills, 25% or 250,000 Kenyan shillings. These are stable, give you a predictable income, and are great for rebalancing when the stock market dips. Real estate gets 20%, that's 200,000 Kenyan shillings. Options include land banking in growth areas, REITs for hands-off investing, or studio apartments in Nairobi. This adds tangible assets to your portfolio. Then we have money market funds, 15% or 150,000 Kenyan shillings. Think of this as your emergency buffer. It's liquid and can act as your easy access cash to grab opportunities fast. And finally, 10% or 100,000 Kenyan shillings goes into a business or side hustle. This is your highest upside potential. Digital businesses, consulting, or e-commerce can multiply your capital faster than traditional investments. There you have it, a balanced 1 million Kenyan shillings portfolio for steady growth and smart risk. Follow this allocation, and your money works as hard as you do. Mistakes to avoid when investing 1 million Kenyan shillings. Let's talk about 5 costly mistakes that can erode your money faster than you think. Mistake number 1, following hype. TikTok, WhatsApp groups, or even your friend's hot tip don't know your financial goals. Investing without a plan is like driving blindfolded. Mistake number 2, emotional investing. Don't panic when your portfolio dips. That's a fast track to locking in losses. Stick to your strategy, don't chase the panic. Mistake number 3, no diversification. Avoid putting all your money in one stock, SACCO, or fund. If that one investment fails, your whole plan fails. Spread it out. Different assets have different risks. Mistake number 4, ignoring fees. Transaction costs and fund management fees quietly chip away at your returns. Always know what you're paying. Mistake number 5, overestimating your risk tolerance. 1 million shillings is serious money. Just because you think you can handle high-risk investments doesn't mean you should. Protect your capital. Avoid these mistakes, and your 1 million shillings has a far better chance of growing. At the end of the day, money grows fastest with clarity, diversification, and discipline. And your first 1 million Kenyan shillings should be protected as much as it has grown. And if you want to find out which grows your million faster, MMFs, treasury bills, or SACCOs, watch the next video.